It's Brian Preston, the money guy.
Understanding that America has a debt issue. And this is one of those things where, guys, the sooner you realize, you have to figure out, are you a builder of wealth? Or are you just a consumer of resources and you use debt to build that bridge to get you where you want kind of before you're actually ready? And that, by the way, when you build that bridge, it's dangerous.
Now, sometimes, right, in our financial lives, we have to go into debt. Maybe we're buying our first automobile or making a home purchase. And other times it's voluntary. We might be buying something at a retailer. We might be running up credit card debt. Either way, most of us at some point in our life are going to be faced with the decision of what's the best way to get rid of it? How do I want to pay it off? What's the best mechanism? So I think that even though we predominantly talk to financial mutants who don't generally, even though America has a debt problem, they might not have a debt problem. There's probably going to be a season in their life or the life of someone that they interact with where this will be valuable, helpful information for them.
Oh, no doubt. I mean, even financial mutants, when you're starting out and trying to build your toolbox of knowledge of what to do with your money, you could also fall prey. So we're trying to help everybody understand, know where money is used, how to grow it, and how not to fall in the traps. And debt's one of those big ones to avoid.
Now, I think this is a bit of an alarming stat because FTE Daniel pulled this up for us, and this is what he found. The average American, this is from data compiled by Northwestern Mutual, the average American now has $26,621 in personal debt, and that excludes the mortgage. The average person's walking around out there with almost $27,000 that they owe to someone else for something they've purchased.
Yeah, and I think you've said it, but I think it's worth repeating, excluding mortgages. Because when you see bigger numbers where you're getting into 5 digits, you're like, well, anything, that's not just credit cards. That's not just car loans, is it? No, let's get into why this is a problem. And part of what I don't like about it is that you learn very early, or at least hopefully if you're watching the Money Guy content, we talk about how easy it is to create financial independence and success with the 3 components of wealth building, which is basically discipline, that deferred gratification that creates margin, meaning you have to live on less than you make. And then you think about from there, you actually create money, because that's what that margin is. It's money so that you can invest the margin, the extra, and then hopefully you have enough time to let those assets grow, your army of dollar bills. The problem is debt works against all 3 of those. Because if you're using debt, especially for lifestyle, that means you didn't create margin. That means you actually exceeded what you made. You used debt to kind of bridge the gap. So you never got to invest the money. And you definitely, if you didn't get to invest the money, you don't have the time to let it grow. You might actually be turning compound interest upside down.
That's exactly right. It can be the 8th wonder of the world that can be wind at your back when it comes to wealth building and building towards financial independence, or it can be the headwind that you're going to fight against your entire financial life if you don't get it under control early on.
So I saw this on Twitter. Brian is, obviously a friend of the show. We communicate back and forth with each other, and I say something to this effect on the show, but I was like, why didn't I create this? I mean, Brian did a really good job because there is a choice being made. Do you want to be a builder of assets, or do you want to make the banks rich? That's the perfect illustration here. So choose accordingly and be wise with this.
Now, here's the truth of the matter. In our day job, we get to work with successful people all over the country. We're fee-only financial advisors, and we work with a lot of millionaire families out there. And one thing that I think is so interesting is that most millionaires, most folks who've been able to build and accumulate wealth don't have debt issues. They fall onto the other camp. They're not the type that ends up getting themselves behind the 8 ball of having compound interest work against them.
Yeah, it is. I think it breaks. People have a misconception about that. They come to a financial advisor and expect you to be an expert on bankruptcy, to understand how to get out of credit card debt and other things. And guys, it's just not the fact. It's not the way the world works. If you're a financial mutant, you will come to a point to realize people who are, going to make good decisions with the money don't struggle with basic discipline matters. Now, look, that's not a condemnation on anybody who is struggling, because we've all been young, we've all been without money and resources. I'm just telling you, don't fall prey and go, especially the consumerism with all the ad campaigns, all the discussions, all the voices with friends and relatives. or they act like it's completely okay to be in debt. That is not the case if you plan on taking your finances to the next level.
So, okay, before we can talk about, the best ways to get out of debt, how to actually satisfy debt, let's talk about some of the most common types of debt that we see, some of the things that Americans most often fall in the trap of. And the first one that sort of immediately comes to my mind is credit cards.
Yeah.
Right now, according to data compiled by Experian and Clever, the average American with credit card debt at this present moment owes over $5,000, $5,300 in credit card debt.
I want to make sure I clarify this because this stuff sits out there on YouTube or out there wherever you download your podcast. This is people who are with credit card debt, meaning they're not paying it off monthly.
Yep.
But this means that people actually have $5,300 worth of debt. And then here's a stat that kind of blew my mind because it's very quickly approaching 50%. 47% of households carry credit card debt.
See, now, one of the money guide tenets that we talk about all the time is we have no issue with folks using credit cards.
Yeah.
We actually encourage that. We think it can be a benefit to your financial life. But carrying the balance is a no-no. It's just something you cannot do. I am amazed by the fact that almost half of the population is getting that wrong. Almost half the population does not pay it off every single month. And I think that is terrifying, first of all, and also kind of saddening.
Now, here's what's interesting. We've come through the pandemic because people couldn't travel, spending was kind of cut down, and then there's also been all this stimulus money that's been pushed out into the economy. A lot of these numbers are actually healthier than they historically have been.
So they've improved from previous
Yeah, because a lot of money's been put in the system. I think this is a good point. If you have struggled with credit card debt, but you've gotten the stimulus money, you've also been able to kind of reset your own personal consumption because you haven't been able to do stuff.
Yep.
Let this be the ground zero to kind of set yourself up for success going forward, because this could be a positive moment here.
And the second type of debt that we often see is consumer credit. Like you go to the local big box retailer, local electronics store, and you buy something, you have a credit card specifically with that retailer.
Yeah, and the way these things typically happen, I mean, I don't care if you go to Kohl's, your favorite electronics store.
Nordstrom,
I mean, it
Target.
doesn't even have to, it can be your coffee shop
Yep.
these days. I mean, you just go, mobile app is going to be pushing this. Everybody's trying to sell their corporate card, and they'll give you some type of incentive. If it's at a furniture store, they'll offer you 10% off.
Yep.
They'll give you bonus points if it's through your coffee app. All these things have this incentive, and you might be caught in a moment of weakness and think that the discount is worth you opening another credit card. Guys, or store credit. I will tell you, be very careful with this. I have my own experience shares on this, is that 10% sometimes is not worth it if you're not communicating it with the other people in your household, because those discounts can be...
It sounds like you're saying that from personal experience.
Yeah, we've had credit card, a store credit that was opened earlier in our marriage that resulted in some late fees and interest and other things. And then also, I can tell you from a knucklehead mistake I made, I went because I was so excited with my first house purchase that we bought furniture, and when they, and it's a few $1,000s worth of furniture, so when they offered me 10%, I'm like,
that's real money.
I'm like, that's a few $100s I could save right there. Not realizing, since I had not closed on the house yet, that ding to the credit, it did have an impact on my credit score. So be very careful on how many different credit accounts, including store cards, that you're opening up out there.
Now, don't mishear us. We're not suggesting, don't ever have a store card. If there are stores that you frequently shop at and that you use, and the benefits make sense for your situation, that's okay. You should still pay them off every month. We're not saying don't use them at all. What we're saying is you want to be careful of opening one up at every store you go to try to accumulate the discounts, when in reality, those discounts may cost you more over the long term than you realize.
I want you to be very deliberate with how you use your credit. I mean, there's a reason. Look, we have in the background a credit score that is running on you at all times. There's also, there's crooks that try to use your credit. We recommend, I actually like the thought of freezing your credit through the 3 credit bureaus, because that also makes you much more deliberate with anytime you want to open a new credit line, you have to go unfreeze your credit from those credit bureaus. man, that makes you, talking about measuring twice, cutting once, I like that extra layer. By the way, it's instantaneous, so it's not a big deal, but it does allow you to be a little more deliberate and take the emotionality out of the entire process.
A third type of non-mortgage debt that we often see folks get themselves in trouble with are auto loans.
Yeah.
We all love the big, shiny new automobile. It's something that everyone can see. There's safety features. There's new technology. But what I thought was really alarming is when Daniel was pulling these stats, we found that the average auto loan term for new vehicles right now is 72 months. I think that's just absolutely insane because I know a lot of folks don't even drive cars for that long. So it's insane that people are borrowing for a longer period of time than they actually even own the automobile.
I think the stats are even worse than this because when I was like, oh, the 72 months. People aren't. They realize you divide that by 72 by 12. I mean, we're talking about 6 years here, and I just when you want to have the optimistic goal of you're driving your cars at least a decade, you're going ahead and locking yourself in when you do this type of debt. And we know that's not even the behavior of the typical consumer, but I think it's even worse. Only 26% of new car loans are for 5 years or less.
And so that that flies in the face of all kinds of advice that we could give. Because even 5 years, I think, is realistically probably too long to try to finance an automobile.
Well, and here's why. Let's give you a clue on this, on why auto loans are disasters. Cars depreciate. I mean, the moment you buy a vehicle, it depreciates really quickly to the point that you really, if you were optimizing your cash flow situations, you typically don't want to buy a car until it's used for 3 or 4 years, so somebody else is paying that 40 to 50% of the depreciation out there. So these are not appreciating assets unless we're talking about like a 1967 Camaro or something. Everybody always throws out those antique cars as the exception to the rule.
But are you really financing that for 72
nobody's
months?
doing that. So I'm just telling you, be very careful with cars, and that's why we put the guidance of 23.8. It's something that you really ought to be aware of so you don't get yourself in that type of situation.
And one way that we know folks aren't subscribing to 23.8, where you put 20% down and you don't finance for any longer than 3 years and you don't let your car payment exceed more than 8% of your monthly gross income, we know that people are falling short on that because the average amount financed for new car purchases in this country right now is $35,228. You can look at the average income for the average American in this country. You can see we are way off from 23.8 affordability.
And, we've done so many shows on net worth by age or 401k savings by age. How many 20 and 30-somethings don't even have $35,000 in their investment accounts, but yet they have a loan for $35,000 that's working against them? That's why we do add on top of 23.8. If your car payment is is more than your investments, you're doing it all wrong.
Right.
You always want your investment cash flow, what's going out for your future self, to be better and greater than what you're spending on your depreciating asset.
And then sort of the last non-mortgage debt that we feel like is super, super commonplace these days are ones that I think a lot of folks feel like they can't avoid, right? I have to do this. This is something. It's not even really debt. It's an investment in my future well-being. And of course, we're talking about student loans.
Yeah, and student loans, they still get classified, what's called loosely good debt. Mortgages, student loans, these things are considered good debt in the fact that you're investing in something that's either appreciating or it's going to make you a better version of yourself. But I think there ought to be an asterisk next to that because, watching some of the documentaries and other things on student loan debts, we do have a crisis in a lot of ways is because we've expanded how many majors there are out there. We've increased the cost of education tremendously. And then the way that has all been bridged is they just let young people and parents just sign off and take on more debt. And that seems like a simple solution, especially when you say good debt, because you think, what could go wrong with this? What can go wrong is when you take on more debt than economically feasible for you to pay off. And that happens when you have jobs that their first year starting salary is not even 10 years in the future, your salary is not going to come close to covering the 6 figures of student loan debt that you built up over the years. So we've actually created some guidelines on this. Here's what we'd recommend. Don't take on more student loan debt than what your first year's salary will be right out of college.
Yeah, that's such a great piece of advice because we know that the class of 2019 graduated with an average of $29,900 in student loan debt. And that's the average. That means that half of the folks that graduated had more than that, had a larger amount than that. We all know when we first come out of our career or out of college and start our careers, we don't always start at the top of the pay scale. So if you already start and you're $30,000, $40,000, $50,000 in debt, it's going to take you years upon years upon years just to get back to break even. So if there are ways that you can contain that you can keep that number down, you certainly want to do that so you can get to actually building wealth a lot sooner.
Well, we know that the habits of highly effective people begin with the end in mind. I would encourage you, if you're a grandparent, parent, or you're a student yourself, think about what you actually want to do for a living. Go look at the majors that actually generate the highest incomes, that also pay back student loan debt the easiest. I mean, I would look at that. And then also go look at how powerful it is to consider doing community college your first 2 years. In some states, that's actually even highly subsidized.
Because the only name that goes on the diploma is the one that you ended at, right? It doesn't say, oh, well, I got a degree from University of Georgia, but first 2 years were in community college. It doesn't do that. You just want to make sure that the place you graduate from has the name on there. It might not be worth paying the exorbitant price tag for those early core curriculum classes.
Well, that's why I would have a 360 approach, meaning you're looking at the big picture all the way around when you're comparing whether it's community college, state schools, trade schools, or then the private schools. Just make sure, like I said, begin with the end in mind so that you don't go to some expensive private school, but you end up with a salary that just is not going to be economically feasible for what you're trying to do. Just be very aware of that, because I think that is something that people fall in a big trap on, because good debt can be bad for your financial life if you don't do it properly.